Welcome back to the deep dive. We have a fascinating one today. We are looking at a company that is quite literally trying to build the engine room of the future.
That's a great way to put it.
But the real question is this company the next trillion-dollar AI empire rising from the ashes of, geopolitical chaos? Or is it a cash-burning Icarus flying way, way too close to the sun?
It could be either. The stakes are that high.
We are talking about Nebius Group, ticker symbol NBIS. And by the end of this deep dive, you are going to know if their current $24.8 billion valuation is the bargain of the decade or a total trap. Before we dive in, this analysis is brought to you by stockanalytics.ai. Get institutional-grade research on over 600 stocks for just $10 a month. Plus, request any ticker and download your own video analysis. Start your 7-day free trial at stockanalytics.ai. Now, let's get into it.
Okay, let's set the scene because things have been absolutely wild in the markets over the last 72 hours.
To say the least.
Today is Sunday, February 15, 2026. The markets are closed, but I think everyone is still catching their breath from Friday. It has been a roller coaster. We had the Q4 2025 earnings report drop on Thursday, February 12th. And initially, it looked like a complete disaster.
Right. The algorithms, the machines, they saw the headline numbers and just dumped the stock. It was pure whiplash.
Exactly. The headline was a revenue miss. The algos are programmed to see miss and sell. No questions asked.
But then the humans started to read.
But then humans, actual analysts, started reading the report. And by the time the closing bell rang on Friday the 13th, the stock had ripped back up over 9% to close at $98.01.
So the computers hated it, but the people, once they understood the context, they loved it.
That's the perfect summary.
And that's usually a sign that the story is more complex than a single number. Right?
Precisely. And that is our mission today. We are going to strip away the hype, ignore the headlines, and perform a ruthless Warren Buffett-style value analysis on Nebius. We need to understand what this business actually is because it is definitely not what it used to be.
Part 1, Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding. Okay, let's start with the absolute basics because I feel like there is a massive misconception about this company.
I would agree with that.
If I'm at a dinner party and someone asks me, what does Nebius actually do? What do I tell them? Because I think a lot of people are confused given its history.
That is a fair confusion because Nebius is a new name for an old entity, but the business model is completely fresh. The simplest way to think about it is that Nebius is a neocloud.
Neocloud.
They are a vertically integrated AI infrastructure provider.
Neocloud. That sounds like marketing speak or something from a cyberpunk novel.
It does a little bit, yeah.
How is that different from, say, Salesforce or a standard SaaS company or even AWS?
It's night and day. A SaaS company sells software subscriptions. You pay a monthly fee. AWS sells generic cloud computing storage, websites, databases. It's like a digital Swiss Army knife.
Okay.
Nebius is building the physical factories where AI is made. I like to use the analogy of the GPU landlord versus the AI factory.
Okay, unpack that for me. What's a GPU landlord?
So a GPU landlord is a company that essentially plays an arbitrage game. They buy a bunch of NVIDIA chips, they stick them in a server rack, and then they rent them out by the hour.
Just raw compute power.
Just raw power. It's a low-effort business model. It's essentially digital real estate. You buy the hardware, you lease it out.
Okay, so a low-effort entry, but that probably means low margins eventually, right?
Exactly. It becomes a commodity. It's a race to the bottom on price. If everyone has the same chips, why should I pay you more than the guy next door?
Makes sense.
Nebius is not doing that. They are the AI factory. They are building the entire stack from the concrete of the data center floor to the specialized cooling systems, the networking cables, and, crucially, the proprietary software that manages how those chips talk to each other.
So they aren't just renting out the raw horsepower, they're building the racetrack, the car, and the pit crew too.
That is a great way to put it, yes. And if we look at the growth narrative, the numbers from this week they back that up completely.
Right, you mentioned the miss earlier. So they reported Q4 revenue of $227.7 million. Wall Street wanted about $246 million.
They did.
Which doesn't seem like a huge miss on the surface, but in this market, any miss is punished. Why did they miss that number?
It was mostly timing. It was about getting new server clusters online, logistics, getting power hooked up. The gritty, unglamorous reality of building physical infrastructure.
Right, it's not just software.
No. But if you zoom out from that quarterly number, The year-over-year growth is staggering. That $227 million figure is up 547% compared to last year.
547%.
Yeah.
That's a ludicrous speed, even for an AI company.
It is hyperscale speed. Most companies would, kill for 20% growth. These guys are doing more than a 5x year over year.
Right.
But here's where it gets really interesting, and this is the number that the humans saw. This is why the stock rallied on Friday. We need to look at the ARR, annualized run rate revenue.
Okay, the holy grail metric for a recurring business.
It is. It strips out one-time fees and seasonality.
Right, so this tells us what they are on track to make if nothing else changes. It's like the speedometer reading at the exact moment they cross the finish line of 2025.
Perfectly put.
Yeah.
They exited 2025 with an ARR of $1.25 billion. They completely crushed their own guidance. And on the earnings call, they dropped an absolute bombshell of a forecast for 2026.
Okay.
They expect ARR to hit between $7 billion and $9 billion by the end of this year.
Wait, hold on. I need to pause there. Can you repeat that?
$7 to $9 billion.
Going from $1.25 billion to potentially $9 billion in a single year? That is beyond ambitious. Is that even physically possible?
It is shocking. It's the kind of growth curve you almost never see in a company of this size. It implies that the demand for their AI factory is it's insatiable.
It sounds like they're sold out before they've even built it.
That's what it means. It basically says they have sold out every single chip they can get their hands on before it's even plugged in. It suggests they aren't constrained by customers. They're only constrained by how fast they can plug things into the wall.
So what are they actually selling that people want so badly? You mentioned the stack. Let's get a little technical for a second. What is Aether?
Okay, so it starts with the hardware. Their platform is called Aether, or you might see it as AI Cloud 3.1. This isn't just a server, it's a supercomputer architecture.
Got it.
But the secret sauce, the thing that really differentiates them, is the software layer on top of that. Specifically, something called the Nebius token factory.
The token factory, I love the name. It sounds like they're minting coins or something, but they aren't, are they?
No crypto here. In large language models, a token is basically the fundamental unit of data. It's a chunk of text.
Yeah.
Think about 4 characters, roughly. When you ask ChatGPT a question and it writes an answer for you, it's generating tokens. That whole process is called inference.
Okay, let's distinguish this, because we hear training and inference thrown around all the time.
Yes.
Training is teaching the AI, which takes months and a huge amount of power. Inference is the AI actually doing the work, answering the user's question.
Correct. And inference is where the money is going to be in the long run. I really believe that.
Why is that?
Because training happens once. You train GPT-5 and it's done. But inference happens a billion times a day, maybe more. Every time you generate an email, code a website, or create an image using AI, that is inference.
It's the ongoing operational part.
It is. And the Token Factory is a managed service that lets companies run these massive models without needing an army of PhDs to keep the servers from crashing. It's huge for margins because it's a high-value software service on top of the hardware rentals.
So instead of just renting me the car, they are also driving it for me. It's a chauffeur service.
Exactly. And they have some other assets in the portfolio too, right?
Mm-hmm.
I saw something about robo-taxis. Is that just a distraction from the main business? It might look like one on the surface, but it's a strategic asset called Evreed. It's an autonomous vehicle company.
Okay.
They actually launched a robo-taxi service in Dallas, Texas, in partnership with Uber back in December. And they have another piece, Tripleton, which is an edtech platform. But make no mistake, the valuation we're talking about today is driven entirely by the AI cloud. Evreed is a moonshot bet on top. It's like getting a free lottery ticket attached to your share.
Got it. So back to the cloud then. Why are the big boy, we're talking Microsoft, Meta signing multi-billion-dollar deals with Nebius? Well, why don't they just build it themselves or use AWS? I mean, Microsoft has more money than God. Why do they need Nebius?
That is the multi-billion-dollar question, isn't it? And the answer comes down to one word, efficiency. There's a metric we talk about called model flops utilization, or MFU.
MFU. Okay, let's demystify that jargon.
Think of an NVIDIA GPU as a very, very expensive employee. Let's say it's a lawyer billing you $1,000 an hour.
Okay.
If that lawyer spends half their day waiting for files to download or for the printer to work, you are just wasting money. MFU measures how much time the chip spends actually doing math versus waiting around for data.
So it's about efficiency. It's about getting what you paid for from that very expensive piece of silicon.
Extreme efficiency.
Yeah.
Because Nebius built their cloud specifically for AI, not for hosting websites like AWS was originally designed for.
Yeah.
They use specialized networking called InfiniBand.
InfiniBand, that's the cabling that connects the chips.
It's the cabling of the protocol that governs it. It allows thousands of chips to talk to each other incredibly fast. The latency, the delay is almost zero.
And that matters because
Nebius squeezes more math, more MFU,
Yeah.
out of the same NVIDIA chip than Amazon or Google can in many of these large-scale training runs. If you are Meta and you are spending billions on training your next model, a 10% efficiency gain saves you hundreds of millions of dollars.
that makes perfect sense. It's specialized tooling versus a Swiss Army knife. AWS is a Swiss Army knife. Nebius is a scalpel.
Exactly.
Yeah.
And the scale they're building is starting to match that ambition. They're targeting over 3 gigawatts of power capacity now.
3 gigawatts.
3. They are building massive sites in Minnesota, Alabama, and a huge new facility in Bethune, France. They are planting flags all over the map.
It really sounds like they are trying to conquer the world before anyone else catches up. But a ship this big needs a captain. Let's talk about who is steering this thing. Chapter 2. Management evaluation. Okay, this is where the story gets, almost cinematic. We have to talk about the elephant in the room. Arkady Veloz.
We do. Arkady Veloz is a fascinating figure. He's a 62-year-old tech billionaire, a computer scientist by training, and he was the founder of Yandex.
Which was, for anyone who doesn't know, basically the Google of Russia.
It was. And much more. It was a $30 billion tech giant. Search, ride-hailing, e-commerce, food delivery. It was everything. It was arguably the most successful tech company in Europe, technically speaking.
And then 2022 happened?
And then the invasion of Ukraine happened. And everything changed.
And this is where his story really diverges from the typical oligarch narrative we hear about.
Drastically. Veloz didn't just stay quiet and try to protect his wealth. He left Russia, he moved to Israel, and he publicly condemned the war. He used the word barbaric.
Which is not a word you use lightly in that position. That puts a target on your back.
It put him at immense personal and financial risk. He was sanctioned by the EU initially, really because of Yandex's media influence. It was a kind of guilt by association.
So how did he get out of that?
Well, because he resigned from all his positions, divested the Russian assets in a complex deal, and completely restructured the company into a clean Western entity, which is now Nebius, he actually got the sanctions lifted.
That is incredibly rare. Usually once you are on that list, you stay there for good.
It's almost unheard of. It shows a level of political maneuvering and, frankly, ethical commitment that you just don't see often. He effectively burned the boats.
Burn the boats.
He sold the Golden Goose, the Russian search engine, and he kept the AI infrastructure, the core engineers, and the cash to build Nebius from the ground up in the West.
He traded a sure thing in Russia for a risky startup because of his principles.
So we have a CEO who has navigated a geopolitical firestorm and come out the other side. What is his strategy for Nebius now? Is he playing it safe, taking it easy?
Quite the opposite. It's hyper-aggressive expansion. If you look at their capital allocation strategy, it's almost frighteningly bold. In 2025, they spent $4.06 billion on CapEx.
$4 billion in 1 year. That's a 400% increase from the year before, isn't it?
Yes, 404% to be exact. They are buying land and they're buying GPUs as fast as humanly possible.
That's a land grab.
It's a complete land grab. They know this is a game of musical chairs for AI infrastructure, and Veloz is trying to buy all the chairs before the music stops. And they aren't just buying hardware. You mentioned the Tavily acquisition earlier. What is that about? That seems like a different kind of move.
Right. Acquiring Tavily was, I think, a strategic masterstroke. Tavily does something called agentic search.
Agentic search. Okay, break that down for me.
So current search engines like Google are built for humans, right?
Right.
You type a query, you get 10 blue links, you click one.
Right.
An AI agent, like an autonomous software bot that's doing work for you, it can't click links easily. It needs structured data. Tavily allows AI agents to browse the web, extract facts, and verify data without human eyes.
So it's a search engine for bots?
Essentially, yes.
Yeah.
And by buying them, Veloz is signaling that Nebius isn't just a hardware rental company. They want to own the operating system for the next generation of AI agents. It moves them way up the value chain from commodity hardware to high-margin software.
So if I have an AI assistant booking my travel, Tavily is the engine it uses to check flight prices and availability.
Exactly. And Nebius gets a cut of that transaction. It's a brilliant strategic move.
And what about shareholders in all this? With all this spending, are we getting a dividend, a buyback?
Absolutely not. And Veloz has been very explicit about this. No dividends, no buybacks. Every single dollar goes back into growth.
So if you want income, go buy a utility stock. This is a rocket ship, and they're just adding more fuel.
Correct. But importantly, Veloz is on the rocket ship with you. He owns about 12% of the company. That's a stake worth roughly $3 billion.
He's got serious skin in the game.
Massive skin in the game. If the stock goes to zero, he loses billions. That alignment is critical when you are betting on a company taking such huge risks. He isn't just a hired gun collecting a salary. He is the founder, and his entire legacy rides on this.
Okay, so we have a visionary, battle-hardened CEO and a massive growth plan. But can they actually afford it? Let's look at the bank account. Chapter 3, Financial Health. We alluded to the mixed earnings report earlier. Let's break down the profit and loss statement because there's some nuance here that really explains why the stock initially dropped.
Okay, so the headline number that scared the algorithms was the GAAP net loss. They lost $249.6 million in the quarter.
Which sounds bad. I mean, loss is usually a bad word on Wall Street.
It is. But in this case, you have to look closer. A huge chunk of that loss comes from depreciation.
Okay.
When you buy $4 billion worth of servers, accounting rules say you have to write down the value of those servers over time. That shows up as an expense, but it's a non-cash expense.
Right, so it's not money actually leaving the bank account today.
Exactly. It's an accounting adjustment based on the fact that the equipment is getting older.
So on paper, they lost money. But what about the actual operations? Is the business itself profitable before the accountants get involved and start depreciating things?
That is where the good news is. And this is a huge milestone. For the first time ever, in Q4 2025, their adjusted EBITDA flipped positive. They made $15 million in adjusted EBITDA.
So that's the pivot point. That's the moment the lemonade stand actually covers the cost of the lemons and the sugar for the first time?
Exactly. It's proof that the model works. Margins are expanding as they scale. They are proving that the unit economics work. As they add more clusters, the profit margin on each new cluster is healthy. It proves they aren't just selling dollar bills for 90 cents.
Okay, but what about cash flow? You said they are spending $4 billion on CapEx. They must be burning cash like crazy.
They are. Their free cash flow is deeply negative because of that spend. But, and this is important, their operating cash flow, the cash generated from customers actually paying their bills, was positive. It was over $400 million for the full year.
So the core business generates cash, but they are choosing to spend all of that and then some on new equipment.
Yes. And the only reason they can do that is because they have a fortress balance sheet. They're sitting on $3.7 billion in cash.
That is a lot of dry powder. Where did that come from?
Remember, they sold the Russian assets. They didn't just walk away, they walked away with a war chest. While other startups have to go out and beg VCs for money, Nebius is sitting on a huge pile of cash.
Right, so they have cash. Do they have debt?
They do. They have about $4.1 billion in debt, mostly in the form of convertible notes. But because they have so much equity on the books, their debt-to-equity ratio is a very healthy 0.89.
So they're not over-leveraged?
Not yet. But they are burning cash fast, so execution is absolutely key. There's no room for delays.
So let's talk valuation, the price tag. The market cap is around $24.8 billion. Is that expensive?
Well, it really depends on which timeline you live in. If you look at the past, the trailing price-to-sales multiple, it's trading at over 40 times sales.
Whoa.
Which is incredibly expensive.
That's nosebleed territory. That's usually reserved for tiny software startups, not multi-billion-dollar infrastructure companies.
It is. But the market is forward-looking. If you believe their guidance, and that's the big if they actually hit that $7 to $9 billion in ARR this year,
then the math changes completely.
the forward price-to-sales drops to around 3.1 times.
3 times sales for a tech company growing at 500%. That's dirt cheap.
That is the dilemma. That is the value trap, or the opportunity of a lifetime question right there. It is priced for perfection.
So what are the institutional models saying?
The institutional models using discounted cash flow analysis, or DCF, they place the fair value somewhere between $91 and $129 per share.
And we are sitting at 98, so we are right in the middle, maybe at the lower end of that range.
We are. The math supports the current price, provided they execute on that insane growth plan.
Part 2, chapters 4 to 7, market sentiment, ownership risk, and final conclusion. Like and subscribe to Stock Analytics AI. Chapter 4, market sentiment. So we know the math works if the growth happens. But what does the market feel about this stock? Because sentiment, as we know, drives price in the short term.
It's a fascinating split. Wall Street analysts are surprisingly united on this. The consensus rating is a strong buy.
So they are drinking the Kool-Aid. They believe the growth story.
They are. The average price target is $144.60.
Which implies, what, about 47% upside from where we are now?
About that, yes. And the highest target from one of the bulge bracket banks is $211.
Wow. So the pros, the sell-side analysts, think this has a lot of room to run. But
Yeah.
I'm looking at the short interest data, and it tells a very different story.
It tells a very violent story. The short interest is high. Nearly 18% of the float is sold short. 17.85 to be exact.
Okay, for our listeners, explain what that means in simple terms. 18% seems like a lot of people betting against the company.
It is a massive bet against them. It means hedge funds and other speculators have borrowed nearly 40 million shares and sold them, hoping to buy them back much cheaper later on.
Why would they do that?
They are betting that Nebius is a bubble, or that the geopolitical risks will eventually tank the company, or perhaps they just flat out don't believe the $7 to $9 billion growth forecast.
But that creates a really dangerous situation for the shorts themselves, doesn't it?
Extremely dangerous. It's a powder keg waiting for a match. If Nebius announces another massive deal with Microsoft, or if their next earnings report beats expectations again, the price starts to rise.
And the shorts start losing money.
They start losing money rapidly. They have to buy the stock to close their position and cut their losses. That buying drives the price up even further, which then forces more shorts to buy.
The dreaded short squeeze.
Exactly. With a days to cover ratio of nearly 3 days, meaning it would take 3 full days of normal trading volume for all the shorts to get out, a squeeze here could be violent. We could see the stock spike 20 or 30% in a single day if the right piece of good news hits.
So we have a total battleground stock. The analyst says buy, the hedge funds say short. What are the technicals saying? The charts.
The charts are favoring the bulls right now. The stock is trading well above both its 50-day and 200-day moving averages.
So the trend is up.
In plain English, the trend is up. The smart money seems to be focusing on the future guidance, not the backward-looking revenue miss.
Speaking of smart money, let's see who actually owns this thing. Who are the big players at the table? Chapter 5. Ownership structure. I always like to follow the money. Who is buying and who is selling tells you a lot.
And there has been a fascinating rotation in the institutional ownership just recently. We look at the 13F filings. Those are the quarterly reports big funds have to file showing what they own.
Okay.
Orbis Allen Gray, which has been a long-time holder in this name, has been selling. They've been trimming their position.
Taking some profits off the table.
Most likely. They've had a great run with the stock, and now they're cashing out some of those chips. But look at who is buying what they're selling. BlackRock,
The Leviathan.
the world's largest asset manager. They initiated a massive new position in the last quarter. When BlackRock enters the room, it changes the conversation.
What does that signal to you?
It validates the infrastructure narrative. They aren't viewing Nebius as a risky tech bet. They are viewing it as essential infrastructure for the 21st century, like a utility company or a railroad.
And it's not just the Wall Street suits, right? I remember hearing that some Silicon Valley royalty is involved in this too.
Yes. In their big equity raise back in 2024, they brought in some very strategic partners. NVIDIA itself invested,
The kingmaker.
the kingmaker, and Excel, the legendary venture capital firm that backed Facebook and Slack.
That is a huge stamp of approval. I mean, if NVIDIA is investing in you, they probably aren't going to cut off your chip supply anytime soon.
Exactly. It solidifies that crucial supply chain relationship. This isn't just Veloz's company anymore. It has deep Silicon Valley DNA now.
But Veloz is still the king, right? He's in charge.
He is. We mentioned his 12% stake earlier. He controls the voting power. This ensures the long-term vision stays intact, which is a good thing. But it does concentrate the risk. It's key man risk. If something were to happen to Veloz, the company loses its navigator, and that would create a lot of uncertainty.
And speaking of risk, we have been painting a pretty rosy picture so far. Hypergrowth, billionaire backing, BlackRock buying in. But there has to be a catch. There's always a catch. Chapter 6, risk assessment. Let's do a SWOT analysis, but let's really focus on the threats. What can kill this company?
Okay, let's go rapid fire on the SWOT first, just to frame it.
Go for it.
Strengths. Proprietary tech like Acer, a massive cash pile, and early access to the best new chips like NVIDIA's Blackwell and Vera Rubin platforms.
Weaknesses.
Extreme capital intensity. They are burning billions of dollars to grow. It's a high-wire act.
Opportunities.
Agentic AI with the Tavily integration is huge and expanding to Europe to bypass U.S. bottlenecks and tariffs.
Okay, now the threats. What keeps you up at night regarding Nebius?
The single biggest existential threat is trade policy, specifically the U.S. tariffs of 2025.
Right. Establish the context here for anyone who might have missed it. In 2025, the U.S. government slapped massive tariffs on imported tech components.
It was a sledgehammer, not a scalpel. 100% tariffs on imported semiconductors and server components from certain regions.
100%. So the price of a chip effectively doubles overnight.
Effectively, yes.
Yeah.
The total hardware cost for the industry has risen by nearly 75% in some cases because of this. This is the single biggest risk to the business model of every cloud provider.
How so?
Nebius is trying to build factories full of these chips. If the bricks for your factory suddenly cost 75% more, your entire return on investment calculation just crashes.
That sounds like a margin killer, a complete margin killer.
It is. The dilemma is, can Nebius pass these costs on to their customers like Microsoft? Or will Microsoft just say, no thanks, for that price, we'll build it ourselves in the US?
And this is where the European expansion comes in, right? The big French data center.
Precisely. This is the hedge. By building the massive site in Bethune, France, Nebius is creating a potential tariff-free zone for their non-US clients. They could serve European companies, Middle Eastern clients, global entities without paying the US tax.
It's a brilliant geopolitical maneuver.
It is, but it's a race against time to get those facilities built and operational.
Okay, what about competition? You mentioned the two-front war earlier.
Yes, this is the other major threat. On one front, you have the hyperscalers, Azure, AWS, Google,
The incumbents?
with unlimited money. If they decide to crush Nebius on price, they can bleed them dry. They can afford to lose money on AI hosting for years just to win market share. Nebius cannot.
And on the other front, the second front.
The other neoclouds, companies like CoreWeave and Lambda, they are scrappy, they're fast, and they are fighting for the exact same customers and the exact same shipments of NVIDIA chips.
So what's the risk there?
The risk is commoditization. If GPU compute just becomes a commodity like electricity or bandwidth, prices will plummet. Nebius needs to prove its software. The token factory, the Ether platform, makes them special. If they are just seen as another company renting chips, their high margins will eventually collapse.
So it's a race to build a software moat before the water level of commodity pricing drops.
That is the perfect analogy.
Chapter 7. Conclusion. We have unpacked the business, the boss, the money, and the minefield of risks. Let's synthesize this. Let's put it all together.
Right.
What is the bull case for Nebius?
The bull case is that Nebius is the fastest growing infrastructure company on the planet, period. 547% growth, positive adjusted EBITDA, which proves the model works, massive contracts with the biggest companies on Earth, and a unique software moat that makes them more efficient than Amazon.
And the bottom line.
If they hit $9 billion in revenue this year, buying the stock at $98 is like buying Amazon in 2005. It's a steal.
Okay. Now give me the bear case. Paint the picture of doom.
The bear case is that it's a house of cards built on debt and burning cash. The U.S. tariffs could crush their margins, the intense competition could drive prices into the ground, and they could run out of money before they reach a sustainable scale. It's a race against time and gravity.
So what is the final verdict? Is this a buy, sell, or hold?
My verdict is that this is not a safe stock for your retirement fund. Let's be very clear. Do not put your grocery money in this stock. It is a high-octane, high-risk, high-reward infrastructure play.
But the price, is there value at $98?
At $98.01, it sits at the low end of that fair value range of $91 to $129 that the institutional models are spitting out. It offers a margin of safety, in Buffett terms, if and only if you believe in the AI supercycle and in this team's ability to execute. You are buying $1 of future growth for about 80 cents today.
Okay, so here's a provocative closing thought for you listeners to chew on. We talked about the Tavily acquisition. Everyone sees Nebius as a hardware landlord.
That's the common perception, yes.
But what if they aren't? What if, by acquiring Tavily, Nebius is quietly transforming from a hardware landlord into the operating system for the future of autonomous AI agents? If they control the software layer where agents live and work, the hardware is just a means to an end. That would make them infinitely more valuable than just another server farm.
That is the trillion-dollar thought right there.
Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai. For just $10 a month, you get full access to our deep dive video library covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.
Make sure to subscribe to the podcast so you don't miss our next deep dive.
And a quick reminder that this analysis was AI-generated research and is not financial advice. Please do your own due diligence.
Thanks for listening. We'll see you in the next one.